One of the most popular brands in the world has fallen 37%. And we think it might actually finally be priced correctly. But is it really a deal? Or is there danger ahead? So let's break this down and reveal what we would actually pay to own it. It's not every day that a premium brand with strong historical growth, local customers, and a solid business takes a 37% hit in 1 year. But that's exactly what's happened, and it got our attention. Now, before you get too excited, here is something very important to understand. Just because a stock drops does not mean it's automatically a good deal. The real question is, why has it dropped? And then, did the drop get caused by a short-term issue or something more serious and long-term? In this video, we're going to explain in simple terms why falling stock prices can sometimes be a great thing. We'll share a great real-world example of a stock that went through a huge dip and came back strong. We'll talk about the story, the numbers, and future possibilities, and most importantly, how to know what price actually makes sense to pay, because that is the most important question when analyzing a company. What is the right price? By the end of this, you'll understand better if this is a dip for a golden opportunity or if it's a trap. So imagine walking into your favorite store and seeing a $100 pair of shoes on sale for $60. Same shoes, same quality, just 40% cheaper. That's what an undervalued stock is all about. In the stock market, great companies sometimes get ignored or punished because of short-term problems that are probably more perception than reality. Their stock prices drop, even if the business itself is still fundamentally doing well. That's when investors like Warren Buffett start to pay attention. They look for these companies that are now on sale. Why? Because when the market realizes what the company is really worth, the stock price will go back up. Because in the short run, stocks are a voting machine. In the long run, they're a weighing machine. And smart investors make money when the short run punishes a stock, but the long run is getting better. Warren Buffett says it best. Price is what you pay, value is what you get. What really matters to Buffett is what you're getting for your money, not the price you're paying. He also says that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. It's not about guessing the next hot trend. It's about buying a great business when it's temporarily on sale. Think of it like buying $1 for 60 cents. It takes patience and smart thinking, but it works. Now, guys, let me tell you a quick story about one of the biggest on-sale moments in recent history. It's a big example, but it shows the point very clearly. Meta, the company behind Facebook, Instagram, and WhatsApp. 3.5 billion people per month use their products. Guys, there's only 8 billion people in the world. Almost half of them use their products every single month. Back in November of 2022, Meta stock had dropped all the way down to $88. In fact, I got lucky enough, keyword lucky, to buy on that low of $88 on November 4th. Now keep in mind, that wasn't the only time I bought. I bought as it was falling. And the comments on the internet were crazy. Mo, do you remember all those comments as we were buying Meta, what they were saying?
Yeah, they said it's a dead company. We're crazy.
Zuckerberg's an idiot. He needs to be fired.
He's spending too much money on the metaverse, etc.
You guys don't get it. See, this is a dying company.
Yeah.
Guys, this was like buying a $700 iPhone for $100. People were scared. The company was spending billions on the metaverse. They weren't losing money overall, but they were spending over $10 billion a year. And there was no end in sight. This metaverse was a big virtual world idea that sounded more like science fiction than smart business. And while they were doing all this and all this spending on the metaverse, their main moneymaker, ads on Facebook and Instagram, was slowing down. Investors panicked and sold the stock. Not only that, they said Zuckerberg is over, he needs to be fired. But here's the thing. If you believed Meta was still a strong company underneath, and you bought at that low price, you were in for a big surprise. Less than 3 years later, by June of 2025, Meta stock had hit $750 per share. That's over 8 times your money in less than 3 years. This is the dream of every value investor. Find a great business that is misunderstood and people are only following the stock price. While everyone is scared, you're waiting for the market to catch up. What does this have to do with the stock we're gonna look at today? Well, that stock is Lululemon. Just like Meta, Lulu is a well-known brand that took a big hit, but it might still be a strong business underneath. That's why it's caught our attention. Let's look at what's really going on with the company. Now, I'm not saying that Lululemon is going to be 8 times larger stock price here in the next 2.5, 3 years. What I'm saying is Lulu is a brand that's loved by a lot of people, especially women. So what's the real issue with Lulu? Their stock is down 37%, and here's why. First off, stiff competition. Brands like Alo Yoga and Vuori are popping up everywhere, using influencers and stylish marketing to steal some of Lulu's spotlight. So this is a lot different than Facebook. So the company of Meta owned Facebook, Instagram, and WhatsApp. So even if Metaverse didn't work out, they still have these 3 fundamentally strong businesses. Now, Lulu has a lot more competition. It's pretty clear that Facebook, Instagram, and WhatsApp are dominant in their areas. Second, Lulu is facing economic pressure. Tariffs and weaker demand in key markets like the US and China are making it harder to grow profits. And third, inventory issues have caused popular items to go out of stock while less popular stuff is piling up and getting discounted. Here's the flip side. Lululemon still has a huge, loyal customer base, strong financials, and is expanding into new products and global markets. Their online sales are booming. They have very little debt, which is extremely important, and they're even focused on being more eco-friendly. Add in smart leadership and long-term trends in athleisure, and you've got a company that, despite the drop, might just be on sale for patient long-term investors. With Lululemon's strong brand and a much lower stock price, it's a story worth diving into. But is the price right? Is the growth real and sustainable? That's what we're here to figure out. So let's break this down the everything money way, using smart, principle-driven steps instead of guessing or following emotions. Let's dig in. So here's what's interesting, Mo. The stock's currently at 226. Mm-hmm. It first crossed the 220 mark back in November of 2019. All right?
Right.
So December 2019 okay. So let's go back to there. Let's go look at their financials. Let's pull up the income statement. 2019. Here's what's interesting, guys. Mo, what did they do in revenue in 2019? Do you see this?
It was 3.29 billion. Yeah.
What did they do in the last 12 months?
Record revenue of 10.59 billion.
So guys, this company is 3.1 times greater than it was the last time the stock was at this, the first time the stock ever hit this price. Keep in mind, that doesn't mean it's cheap, right?
Yeah.
But it's just something interesting to look at to show the emotion of it. If I had told you back in 2019 when the stock first crossed 220, that 6 years later, the company would make 3 times more revenue, where would you think the stock would have gone?
700 a share.
Easily, right?
Yeah.
You'd have thought that.
Yeah. Look at the net income.
483 million versus 1.8 billion.
Yeah.
4 times larger.
Record profit.
3 times more revenue, 4 times more profit, and the stock is flat. Now, we've seen this in other companies like Tesla and Amazon. Their revenues and profits are way higher than they were years ago, but the stock is flat. This is the proof that principle-driven investing idea that in the short run, stocks are a voting machine. In the long run, they're a weighing machine. Okay, so that's just one thing to keep in mind if you're new to investing and going, wait a second, how is this possible? Because people's emotions take over. Now, market cap, $27 billion, enterprise value, $29 billion. This difference right here is essentially their debt. So their debt is around less than $2 billion. You know what's amazing, Mo? Last year, they did $1.3 billion in cash flow.
Wow.
That means they can pay off their debt if they just replicate this cash flow for a total of 20 months, roughly.
Based on the metrics that we just saw in the income statement, they're going to do it.
That's what it seems that way.
Yeah, that's the trend.
Now, if you're in our community, I encourage you to keep giving your voting. This is the voting over the last 6 months. And right now, we have 41 community members who've rated this a buy. 2.4% rated a strong sell. A lot of people like this company. This is not an endorsement of the stock or anything like that. It's just saying these are our community members voting on their own. Okay, a couple other things. One thing I'm not a huge fan of, net income last year was 1.8 billion versus cash flow of 1.3. But Mo, if you look, 1.2 billion in the last 5-year average versus 1 billion. So they're a lot closer there. 15 PE, 20 times free cash flow. Does this sound expensive? Maybe, but look at this. Return on invested capital.
Very high.
Guys, if this sounds overwhelming, we're throwing a lot of things at you and you're not alone. We're here to simplify this as much as we can. This return on invested capital is what kind of return do they get when they invest money in their business? Great companies have high returns on capital. This is very, very high. This means when they invest money in their business, they get really big returns. The higher this return on invested capital, the higher the premium company and the more you should pay for it. You should give it that premium. Another thing I love, well, look at this gross profit, 60%.
In retail.
In retail. And it's growing even with markdowns recently.
Yeah.
And Mo, 15% 5-year profit margin,
Growing.
17% last year.
Yeah.
So if I didn't hear any of the story about Lulu, what would I have thought here?
You would think it's great.
Metrics are getting better.
Yeah, everything's improving.
Everything is improving.
Profit margins are improving. ROIC is improving. Everything's improving.
Everything is improving. So this is what we're talking about here. The market and its reaction to the news versus the real fundamentals. Doesn't mean this can't turn around and become bad.
Of course not. Could.
It could. I think the most important thing here is more anecdotal. You know, Philip Fisher in his book talks about scuttlebutt.
Mm-hmm.
Go out there and ask women who go to Lulu. One thing is interesting is 10 years ago, Lulu was only a women's brand.
Yes.
I still remember the first time a guy telling me, you know who makes the best pants? Lulu for men. I'm like, come on. He's like, yeah. I was like, holy cow.
Yeah.
How much Lulu do you wear, Mo?
I have their golf pants.
And how much you love them?
They're awesome. They're my second favorite pants behind Nike.
Behind Nike.
Yeah.
Of course.
But they're great pants. Don't get me wrong. They're awesome. Now they've gotten into the shoe brand for men.
Oh, have
like
they?
They used to only have women's shoes. Now they have men's shoes. They're starting to get in the golf world.
Now
Got
it's
some
interesting.
Sponsors on tour.
So Mo, who do they endorse on the PGA Tour?
Minwoo Lee, just one.
Okay.
And Max Homa.
Oh, Max Homa, I
Who doesn't
know.
Max Homa.
But not
So,
Scotty Scheffler.
Not Scotty Scheffler. Nike.
Nike, there you go. Now, in a few minutes, I'm going to tell you the price that I would pay for the stock based on my assumptions. But if you're interested in getting these key metrics, to have it sent to you over email so you can follow along in future videos and even on this video, to understand the key metrics that I look at, click the link below. In a matter of 1 minute, you will get this email PDF directly to you, absolutely free. I really want you to get the most out of these videos by understanding the terminology so you don't sit there and feel overwhelmed. Now, one thing that has been very popular for our channel is our 8 pillars. So Mo, look at these 8 pillars for Lulu. High on the 5-year PE and 5-year price to free cash flow. Everything else is a check.
And the 5-year PE is high by 0.09.
Correct.
So it's right there.
So I look at this going, gosh, revenue's up $7 billion, net income's up $1.2 billion, cash flow's up $900 million. They bought back shares, not necessarily a good thing. Remember, guys, we want companies buying back cheap shares. As the stock has fallen, we want the company to look at this as an opportunity to buy back shares. This would give the investors in the business a bigger piece of the company by them sitting back and relaxing. And it's a great way to increase shareholder value. Now, I don't know how often they get updated here, but here are the analyst estimates on the company. And for a company that's dying, analysts certainly don't believe so.
Jeez, oh man.
$14.60 per share in profit going to $25. 15%, 3%, 9%, 8%, 27%, 13%. And obviously, the further out you go, the harder it is to determine. But guys, top quality brand that women love. Yes, there's a lot of competition. The question is, who's going to rise to the top? Who's going to keep innovating? That's the biggest thing here. Revenue. Mo, look at this revenue growth. They're looking at 50% growth here in the next 5 or 6 years.
That's very large.
It's a lot of revenue growth, but it isn't the growth story that it was before. And that's very important to understand. Over 6 years, they tripled their revenue. Now, over the next 5 years, they're looking at 50%, 60%. So that growth story might be over. But remember, guys, you don't need growth to make a lot of money. If I told you hypothetically there's 2 companies out there, everything's the same revenue, same profit. One's going to grow at 20% a year, one's going to grow at 5% a year. All things being equal, you should pay more money for the 20% per year company growth. Absolutely. But what if one was $1 for the entire company and one was $1 trillion? Which one's better now?
$1.
Of course. That's what we're trying to teach here. It's paying a price, but what's the value behind it? I will take a declining business for free, of course, versus a growing business that to pay an infinite amount of money for. That's the way I want you thinking. Guys, same-store sales are declining. That's an issue. But remember, we're seeing that across a lot of retailers right now. To us, Mo, what have we always said with that same-store? It's like, maybe the economy isn't as strong as people think.
Yeah. I would like to see the increase in online sales. Is that something that is
Let's
changing?
look it up.
Let's look at it. Because if you think about it, if, let's say that people are going to the store less, but they're buying online exponentially more. Maybe that's not a bad thing.
And by the way, if they believe in the brand enough that they can buy online without having to go in the store, that to me is brand loyalty, right?
Yeah.
They had their gross margin increase by 0.6%. That's a lot for gross margin. People are really worried about the markdowns. Now my question becomes is that because people see the stock price down 40% that they're finding the story? Because news follows the stock price, not the other way around. I say that over and over to show you that stock price declined. Let's go find the news that justifies that stock decline. And by the way, this is a great lesson to learn that when the stock was flying high like this, maybe that growth story wasn't as good as it's going to be. People follow this and say, oh, the company's great. Now they're looking at this and saying the company's crap. Guys, I want you to be the person who says, hang on a second, let me make sure the company's as great as it is. Hang on a second, let me make sure the company's as crappy as people say it is. That's what we're trying to teach here. Well, Mo, look at this. Here are their online sales by year going back to 2014.
Jeez.
Okay, so remember in 2019, we said their sales were up 3.6 billion?
Yep.
So 3.6 billion, $1 billion of 3.6 billion is roughly, what is that? Not even 30%, 28%. Okay, now it's 3.6 billion out of 2024 numbers. So in 2024, they did sales of $9.6 billion. So 3.6 on 9.6 is roughly 40%. No, roughly 35%.
30, yeah.
So it's an increase.
It's increasing. Okay.
Not as much as I would have thought, though.
I would have thought more.
I would have thought way more.
Yeah.
But you look at this and say, okay, this is a lot of growth for the company. And you saw this growth. And guess what you saw that with? How did the stock price look at this point? That's the big thing to remember, guys. But we're here to talk about keeping the story and the numbers separate and then merging them later. Guys, this company could be a fad. It hasn't been around an egregious amount of time. It's a relatively new company. But the question becomes, if it's not a fad, what could it be worth? Now, Mo, besides just investing in the company, what do the charts say? Now, for those of you who are new, I like looking at charts as a way of putting money and trying to make money, not caring at all about the fundamentals. And a lot of people will sit there and say, well, Paul, how can you be a value investor and this? Well, Michael Burry's one. Every value investor does have, a lot of them have chart people in their office to say, hey, where's the momentum going, et cetera. I look at it saying, it's just another way to make money. So Mo, go ahead.
So I have these two yellow lines here, and this yellow line on the bottom, this is kind of your big support level. And you can see, even when back in 2021, it dropped, it kind of got to that yellow line. In 2024, it hit that yellow line and bounced. It hit it earlier in April. We're kind of at that level now. So to me, this is a really, really good bottom. So if you're a chart person, you're looking at this saying, okay, well, I'm obviously looking to run this thing up, go long on the position to about 350. I think over the next 12 months or so, you're going to see this bounce between 230 and 350, and it's just going to go back and forth in that range. But it's just a range-bound stock, huge range, but it's a range-bound stock. So if you're interested in trading it, you kind of know where your parameters are. You know where your guardrails are.
And if it breaks that range, watch out in either direction.
In either direction. If it breaks the range down, watch out. This is going to COVID levels, $100 a share.
Really?
Yeah. If it breaks out to the top, maybe you're going back to 515, which was the previous highs. You just need momentum.
Wow. Okay. So guys, like I said before, what we're here to do is merge the story and the stock price. We sit there and put into our parameters here on Stock Analyzer, what is our future revenue growth? What's the future profit? Multiples, et cetera. And then what is your return? Guys, we don't know the future. This is why we need that margin of safety. But it's a great place to go to merge all of these things together. So here are my assumptions for the next 10 years. And Mo, tell me where you agree or disagree. Revenue growth. I put low of 4, middle 7%, high of 10% per year.
I think that's fine. Could be a little low, but I think it's fine.
Okay. Profit margin, I did 14, 15, and 16, and I went a little bit lower on free cash flow, even though I think they'll catch up. They're probably a growing company investing more in fixed assets.
I think it's fair, though.
PE. Now, remember, this return on capital is increasing. So to me, this deserves a premium. 15 on the low side, 19 in the middle, 23 on the high side. This is what multiple to be 10 years from now. Mm-hmm. What should it sell for? Yep. What do you think about that?
I think it might be a little low again. But
really?
It's a premium brand. I mean, it is one of the higher end athleisure brands.
Okay, what about 16, 20, and 24?
I think so.
Okay, let's do 16, 20, and 24. And guys, this is why this thing is used millions of times per year by our users. Because You can sit there and modify things as you have conversations in our community. And finally, 9% desired return, no margin of safety. It's the market return. But remember, guys, if you're going to buy individual stocks, you need margin of safety. Because if you can get the market return by investing in ETF, why deal with all the hassle? This is just to say, what is my intrinsic value for the company? Now, before I tell you that price, what I've seen from Lulu, I like. But the price relative to the value is really what's going to matter. Believe it or not, 20, 25 years ago, I was a lot like the average person out there. I would chase stocks. I would follow tips. I would get caught up in the hype, hoping something would stick. That's not investing. That's gambling. And after major mistakes in that, I learned that lesson. And that's exactly why we created Everything Money. We wanted to give all the people like me from 20, 25 years ago the tools, the strategy, and the community that I needed. Joining Everything Money gets you access to all of our software, a private group of serious, like-minded investors who aren't guessing anymore. But let's be very clear here. I do not want you to join if you're the kind of person who jumps from one shiny thing to the next. If you look for a quick fix, this is not for you. If you're not willing to put in the work to get better, like we both do every single day, if you're not willing to follow a process, this isn't for you. We're building a community of committed investors who are in it for the long haul. If that's you, you can start your 7-day trial right now. Click the link below. Just know, though, that we limit the spots every single day. So we don't know how long the trial will stay open. And at some point here in the near future, it's going to be an application process. So if you're serious, now's the time. So I hit the analyze button. Boom. All right, Mo. I got a low of 200 to 215, a high of 475 to 508, and a middle price of 300 to 330.
Okay.
So the question becomes, are these return levels below, based on today's price, worth it for you? Now, guys, using these same ideas on Lululemon, I want you to see this next video where I picked 7 of my own personal Magnificent 7 using the value first strategy that we just talked about. And as of right now, they're actually beating the real Magnificent 7. So click on the video on your screen to see which stocks made the list and why they could keep winning. Thank you for your time.